If we review 2022 and first start on the downside, we can see MSCI China was down 16%. That's after a tough 2021 as well, down 15%. And that's really in the back of a zero COVID policy and regulatory issues that started in 2021. There has been a small rebound in the economy into 2023, and that supported the index this year. MSCI World and the S&P indices were also under pressure last year, down 12%. And that's really on the back of increasing interest rates, putting pressure on the valuations of stocks in those markets, so them under pressure. And that really fed into US Treasuries as well, down 6.5% or down 12.5% in dollars, one of the worst years we've seen for US Treasuries in recent history. Surprisingly, the Euro Stock Index was only down 0.5%, so relatively resilient, even though there was a war in Europe and they had an energy crisis. On the upside, the capped SWIX, our index, did relatively well, up 4.4%, and that was driven equally by dual-listed stocks on the JSE and domestic SA equities, both up 5% and 6% respectively. That's very different from last year, where the capped SWIX also had a good performance, but that was mostly driven by domestic SA equities. If we then turn to the Nedgroup SA Equity Fund, we can see that up 11%, so having a very good year on an absolute basis and on a relative basis compared to the capped SWIX. This is just a graphical representation of the fund versus its index and peers over time, and you can see the fund has handsomely outperformed both the index and peers over time. It's the top dark green line. If we then break down that performance into various different time periods, you can see over the last quarter, the fund performed well on an absolute basis, up 12%, but basically in line with its index. In 2022, the fund had a really good year, as mentioned, 11% up, and that's over 6% alpha against its index. If we look at other annualized periods, 3, 5 years, and since inception, the fund has outperformed both its index and peers over all periods, and has generated 1.5% alpha since inception against the index and 2.5% alpha against peers since inception. What I find more interesting is the block below, where we're looking at the rolling monthly performance of the fund versus the benchmark and peers. And you can see over a 5-year rolling period, which is what we think is a decent period to measure the fund has outperformed its benchmark over 80%, and outperformed peers 76% of the time. So that really points to consistent outperformance of the fund over time. If we just unpack what drove the fund's performance in 2022, we had big position in banks. Absa was our preferred bank, and you can see that overweight really did well for us, with the banks running hard, and we have pared back that position. If you remember, in 2021, we started the year with a large position in MTN. That did very well for us. We then sold down to zero as we thought it got close to our fair value. And this year, that underweight in MTN did very well for us as the stock came under pressure. Last year, one of the high conviction positions we had was Mediclinic in the hospital group space. And with it being taken out, that stock also performed very nicely for us. On the downside, we established a position in Telkom. Unfortunately, that stock has come under pressure when the MTN bid disappeared, but we still think the management team there can unlock a lot of value by unbundling the tower business, and we think there's still many suitors that are looking at OpenServe or the fiber business there, including MTN. On Aspen, the stock has been under pressure, but we think trading at a 7 EV/EBITDA, it looks cheap, and it can fill up its spare capacity, manufacturing vaccines into Africa, which would really drive earnings going forward. Maybe 2 other stocks to mention here is Thungela and Exxaro. We had zero in both of those, and they did very well on the back of a strong coal price. Instead, we had exposure to the energy space through Glencore, which was an overweight position and did very well for us. If we quickly go into the market outlook and what we see happening in 2023, first, we acknowledge that the fund performed very well in what was a tough environment here in South Africa. We had floods in KZN, high levels of load shedding, I believe 220 days of load shedding last year, and every day of this year so far there's been load shedding, political upheaval, although a good result from the ANC elective conference, and a global risk-off environment with high inflation and very high interest rates. We think this speaks to the resilience of South Africa, its consumer and businesses here that have learned to operate in a tough space. If we look at 2023 going forward, firstly, Chinese authorities have abandoned their zero COVID policy. This will accelerate the reopening of the Chinese economy and improve global growth, we think. That would be positive for commodities in South Africa and positive for broader emerging markets. We think global inflation has peaked, and that's really due to product and energy inflation rolling over. Product because the logistical issues due to COVID have been sorted out, and energy with a lower oil price. But unfortunately, services inflation with global wage inflation still very high, we think will be sticky. So we think inflation will roll over, but will stay higher for longer than it has been in the past. That feeds into the US interest rate cycle, which we think is entering the later stage. The market is pricing 225 basis points increase in the US, but we think that'll be less supportive for the US dollar than we saw in 2022, where we had a very strong US dollar. Once again, that is supportive for commodity prices and emerging markets like South Africa. And overlaying valuations over all these factors, emerging market valuations sold at a very attractive level, a discount to all other markets, and South Africa at a discount to emerging markets. So we think a very positive environment going into 2023 for the South African markets. Over here, we're just looking at the forward PE of various global markets. And you can see the dark green line, the MSCI South Africa, used to trade at a PE or forward PE in line with developed markets and at a premium to emerging markets. Since 2018, it has derated quite a lot and now trades on a 10 forward PE at a large discount to emerging markets and other developed markets. We think this is very supportive for the local market. If we then look at a proprietary index we put together of basically companies that are really exposed to SA Inc. and what forward PE they're trading on, you can see they at a 10 forward PE, so very cheap compared to their historic PE, and over one standard deviation cheap compared to their history. So we're finding very interesting opportunities still in the SA Inc. space as well, and that's supported by this valuation. If we then just examine how the portfolio is positioned to take advantage of the factors we've just discussed, firstly, on the global consumer side, we've got large positions in Prosus and Naspers. Prosus is still trading at a 37% discount, and we think management, with the buybacks they're busy doing, will push that discount beyond or narrow it beyond 30%, and that's decent upside there. And then on top of it, your main exposure to Tencent in China, which is 85% of the intrinsic NAV. The company is trading at a 16 forward PE, and we forecast very strong earnings growth going forward as China recovers. So big exposure to those two stocks and very bullish on them with great upside in those two. British American Tobacco, we've increased our positions there. The company is trading on a 7 forward PE, 8% sterling yield, and we think that high dividend yield will support the company into what could be a very volatile 2023. So decent exposure to that company as well. In the SA financial space, we entered 2021 and 22 with quite a lot of banks, large exposure there. They've done really well last year, and we've pared that position back. So decent exposure there, and the banks are still trading on high single-digit dividend yields, so well supported, but we have started taking profit there. Selective exposure in the insurance space to Sanlam, we think a high-quality franchise trading at below embedded value, and Momentum trading well below embedded value, and we think they can unlock value in the Indian business. In the SA Inc. space, more selective around our positioning, we're looking for self-help stories or companies that can gain market share with strong management teams and strong balance sheets. Two of these would be Pick n Pay, which is still relatively cheap, although it has had quite a big re-rating, and we could take profit there. And that's really a self-help story. And Motus, where the management has been able to cut out a lot of expenses in the company during COVID, and it still trades at a 6 forward P, so relatively cheap. And we think they've gained market share in the local economy as other car manufacturers have had logistical issues, and we think they can still drive earnings growth going forward. In the resource space, so diversified miners still prefer Glencore on a 15% free cash flow yield. That's really supported by coal prices, even though they have come down, and increasing copper prices. And then Anglo-American, where we see an increasing production profile and supported by valuation on a 10% free cash flow yield. We've also got exposure to the paper and packaging sector through Mondi. Mondi, a high-quality company with a good management team, trading on a 10 forward PE, so cheap compared to where it traded historically, and we think they're going to be able to get cash out of Russia for the businesses they sold there, which increases our fair value on that company by about 20%. We have noticed that peers in the same industry have managed to get cash out of Russia recently, and we're very positive on that aspect. If we then just look at the general sector exposure in the fund, so 28% of the fund exposed to the global consumer, Naspers Process being a large position there. We've also got exposure to AB InBev, BTI, and Richemont. 15% in the bank sector. That has come down as we've taken profit there. Decent exposure to diversified resources at about 13%. And then also some exposure to PGMs at 8%. They have rallied this year, and you could see us taking some profit there when they're closer to fair value. Another sector to maybe point out is 4% exposure to gold, and we have at last seen gold rally quite strongly into this year on the back of quite strong central bank buying. On a look through geographic exposure, the fund is about a 44% exposure to developed markets, about 32% of exposure to the South African markets, and 13% exposure to EM markets outside of South Africa, and that's really to the Chinese market that is recovering at the moment. In conclusion, this is the top 10 positions in the fund at this moment. We can see the fund is relatively well concentrated with 60% of the AUM in the top 10 positions. And we think the fund is very well positioned and nicely diversified to once again generate very good returns for our investors into 2023. Thanks. It's an interesting question. And, South Africa is in a tough space at the moment. So from an SA equity space, what we're worried about is really the South African consumer. And the South African consumer, you have to look at it in two parts, really the high-end consumer and lower-end consumer. The high-end consumer actually has more disposable income than it did pre-COVID, so we think that's pretty resilient. But the lower-end consumer has been knocked quite hard, so less disposable income. There has been job losses, etc. But we think, firstly, so the consumer under pressure, we've seen fuel increases, which puts pressure on them, higher inflation, higher interest rates. And because of that, we may be a little more cautious around retailers in South Africa and looking for retailers with self-help or exposure offshore. We're also worried about sectors that are very exposed to load shedding. The manufacturing sector, that's under pressure. We've seen telcos report, and they're under a lot of pressure because the batteries at the various towers they have go down. Then you don't earn any revenue. And we've also seen their costs increase quite dramatically as they spend more on diesel, running generators for their towers, and more on batteries. So something like a MTN, obviously, that puts pressure on its SA operations. And on top of that, you've got the risk around what we've just seen, the tax fine in Ghana, so regulatory issues in other jurisdictions, and the risk of a devalue in the Naira, which could put pressure on the stock. So maybe a little more cautious around MTN, even though it has traded down quite a lot and the valuation's looking more attractive. So the fund is probably more partial to larger shares. We generally have focused on the top 100. That being said, we are finding very interesting ideas, and we'll take exposure to sort of the small and mid-cap space. One of the companies I've mentioned, Motors, is where we've done that. And the management team has really managed the company well through COVID. They've taken market share, grown earnings, and installed a fantastic valuation at a 6 forward PE. Another company would be Telkom. That's more a value unlock story. So we think that there's a lot of value, and we've spoken to multiple players in that industry, a lot of value in that company, especially in the fiber space. And we think you should see a few catalysts happen in the next, let's say, 18 months to 2 years that unlocks that value, one being an unbundling of the tower business from Telkom, another being suitors found for its enterprise business and its fiber business, which should unlock value there. So yes, we definitely still are finding selective opportunities in that mid and small cap space. So South Africans, we tend to be very negative at points, and I know load shedding has obviously been a huge burden on everyone at the moment, and there's a lot of it. But luckily, load shedding has been coming for a while, and I think a lot of companies and people are prepared for it. So if we look at a company like Foschini, they basically put batteries in, spend 200 million rands on batteries, and it's in 1,000 of their stores, so they can trade right through COVID periods. And we've actually seen resilient results from a lot of the retailers, a lot of manufacturing businesses, and businesses that you would expect traditionally to get affected by load shedding because they've prepared for it. So that's good. For instance, Foschini's manufacturing capacity in South Africa is 75% off the grid. So they've installed a lot of solar and generators. And so while that does increase the expenses, so it could put pressure on the margin, from a trading perspective, We think a lot of companies are actually in a good position to trade through tough periods from a load shedding perspective. We also think commodity prices are well supported by the weaker dollar and an opening Chinese economy. That's obviously very positive for the South African economy and consumer. And then overlaying on top of all of that is the South African valuations, which I discussed. So valuations are very low. And we're finding really great opportunities in the SA equity space. And we think that underpins sort of the investment thesis overall.